In Feb 2018, hedge funds lost millions of dollars, and in fact, two hedge funds completely blew up. The VIX spiked 115% on this day. It was the biggest spike on record. But there was a warning signal 3 days earlier that could have saved every single one of those hedge funds. It was called backwardation, and I'm going to show you exactly how to spot it. First, a quick disclaimer that everything discussed is for educational purposes only, is general in nature, and does not take into account your personal circumstances. Most traders have no idea when the market's about to turn ugly. They're just flying blind. But today I'm going to show you one of my favorite resources, and it's a free website, and it will help you spot when the market's about to turn. By the end of this video, you'll have an early warning system that you can use, and it only takes a few seconds each day to check. I've been trading options for over 20 years, and this is by far the most reliable indicator I've ever found. And I check this every time the market starts acting up, and it's never let me down. So what we're looking at here, this is from vixcentral.com, a free resource. I would recommend checking this out sort of once a week. If the market starts to correct and drop a little bit, you might want to check it out daily. Now, the opposite of contango, which is what we're looking at here, this was August 9th, 2017, the black line. We've got lower volatility in the short-term options. We've got higher volatility in the longer-term options. So that's contango. Then the very next day, we moved into slight backwardation, which is the opposite of contango. Is anyone familiar with contango and backwardation? Hopefully you are. If you've read some of my writing, I talk about it quite a lot. And I have a saying, one of my favorite market sayings: bad things happen in backwardation. Okay, and this is why we want to check this when the market's correcting. So here we went into slight backwardation, and then the market, I think, had a little bit of a drawdown from there. So that was a little slight bit of backwardation, slightly higher volatility here in the very short-term options compared to the monthly options. Now here's a even more extreme example. This was Feb 2nd, the black line was the Friday the 2nd of Feb. We went into slight backwardation. The Monday was a day called the Volpocalypse or Volmageddon. Has anyone heard that term before? So what happened on this day? Volatility spiked 115%, the VIX index. It was the biggest VIX spike on record. Now, they didn't have the VIX in 1987 when the big crash happened then. Maybe the VIX would have spiked more on that day, but 115% was unheard of. I think the biggest spike before that was about 65%. So bad things happen in backwardation. On this day, the Monday, a couple of hedge funds blew up, a couple of volatility-based funds, millions and millions of dollars just gone. Bad things happen in backwardation. So hopefully you'll always remember that saying. So when the market's correcting, we want to watch for backwardation. When we go into backwardation, that's when we start to close out some positions, reduce risk, maybe add some hedges, things like that, which we'll talk about. The other thing to note about this and what happens when we have, a vol spike, as people say, short-term options get impacted the most, right? So we can see here the weekly options went from about 15.5 to about 34, 115% increase. Anyone trading or selling options, selling weekly options here, got absolutely killed. It's generally when you're selling options, you have negative vega, or you're short volatility, you might say. If volatility rises, that's bad for your trades. So option sellers doing weekly options here got crushed. Anyone who was a little bit further out, say 90 days, the vol went from 15 to 21, not nearly as big of an increase. It didn't have nearly as much of an impact on these 90-day trades. That's another reason why I prefer these slightly longer term trades, these 90-day trades. They're less risky in terms of their volatility exposure. Do we refer to VIX only, not individual stocks, IV? We want to look at both. We want to look at the market volatility generally, and then we also want to look at the individual stocks. Now, we do get a bit of noise here, and that's actually a good point. Let's have a look at, let's just go here, and we'll just go and look at NVIDIA. So back to your question, Philip. Bar chart have actually recently added volatility charts, which is amazing because previously we didn't really have this on individual stocks. Now, NVIDIA is showing some backwardation here because of earnings. Now, my saying of bad things happen in backwardation doesn't really apply in this case because it's just related to earnings. It's more the market generally. So yes, we want to look at individual stocks and the market in terms of their term structure of volatility, backwardation and contango. But we're not concerned that NVIDIA is in backwardation. We don't think bad things are going to happen to NVIDIA because it's in backwardation. It's normal. It happens, 4 times a year when they do earnings. Sean says, in the current low VIX environment, do we expect a major correction? It's possible. And we've sort of talked about this with short volatility trades or option selling trades. If volatility is low and it stays low, that's okay. If volatility is high and stays high, that can be okay. If volatility is high and it moves to low, volatility drops, that's really good. The only really bad scenario for us as option sellers is when volatility is low and it goes to high. So we do need to be careful because the VIX is very low. And that's why I'm more on the 90-day sort of trades at the moment, because if there is a correction, if there is a VIX spike, a vol spike, it's not going to impact these options as badly. So this is the current VIX Central. Again, free resource. We're in heavy contango. Now the market did correct. When was it? It was about August 1st, wasn't it? July 31. And what we can do is we can actually go back and look at historical prices. So here it defaults to during the last big crash, we were in heavy backwardation, and we were in backwardation for a long time as the market was crashing, right? If we go to August 1st, which was roughly when the sort of tariff correction happened, we were correcting, the market was dropping. It might have felt pretty uncomfortable, but we were still in heavy contango. So that told me at that time, this is just a normal run-of-the-mill correction, nothing to be too concerned about. So that's really good to check that when we have little periods like this where the market corrects. Is it a serious correction and we're heading into backwardation, or is it just a run-of-the-mill 2 to 3% pullback in an uptrend and we're still in, a calm, normal market? Whereas when we get a spike like this, we go into backwardation. That's when we start to get a little bit more concerned. Sean, yeah, you want to look at April for the correction? I think we did briefly go into backwardation. I think April 7 was about the bottom, wasn't it? Yes, we were in backwardation. And this is another thing that you can get a little clue as to when corrections are ending. So obviously that April correction was pretty bad. We can't see it on the chart here because it's more than 6 months ago now. But yeah, this period was pretty bad and we did have contango. It'd be interesting actually to look at when we first went into backwardation. And it was probably in here around, I think it might have been around here, like March. So it was a little bit late. We did cop some of this drawdown, but it was, let's see. Oh no, we were actually in backwardation in early March. So that's our clue that, hey, this is not just a normal run-of-the-mill correction. This is a more serious correction. So it actually, let's just try and find. So we're in contango here on the 19th, still in contango on the 26th. Around early March, we went into backwardation. And where's our chart? Early March. So around here, we went into backwardation. So we had an early warning signal that something bad was going to happen. Again, you don't need to check this every day, only when the market's correcting. And then when the market started to bottom out, let's go towards the end of April, still in backwardation. Let's go 2 weeks, still in backwardation. There was a lot of fear around this time, if you remember, around the tariffs. Boom, there we go. So May, let's try and zero in on when this went back into contango. Getting close. So around the 12th of May, which is around here, probably on this big jump here. This was about when we went back into contango. That's like almost getting an all clear signal, right? Yes, Nicholas, good time to buy puts when we go into backwardation. Absolutely. Great time to reduce risk, buy puts, add hedges. Yep. And then once we go out of backwardation back into contango, we've got the all clear. That's a good time to get back in. Another term I use for backwardation is panic mode. That's when people are panicking, forced selling, margin calls, all that sort of bad stuff. And that's when all these bad drops can happen. Every major big market correction or crash has happened after we went into backwardation. So there you have it, the secret weapon for spotting market turning points. When the market starts correcting, remember to always check the VIX term structure. Make sure to check out all the resources in the description below. Reach out anytime with questions. Thanks for watching and have a great day.